15 of 21 series are aligned with an acceleration mild configuration this morning. That is a moderate level of agreement across the framework's macro and market indicators. The current macro regime is acceleration mild, with a confirmation score of 15 out of 21. In this macro regime, the engine is observing growth momentum accelerating at about plus 0.04 and inflation momentum accelerating at about plus 0.02, both positive rates of change, which means the growth composite and the inflation composite are rising rather than falling. The coherence score is described by the framework as moderate, reflecting that the 21 series are not perfectly synchronized, but a clear majority are pointing toward the same acceleration pattern. By our framework's historical math, regimes with a confirmation score in this range have persisted in roughly 47% of comparable 3-month windows, with the most frequently observed next configuration being a stagflationary one, a record of past behavior, not a forecast. Compared to last week, the shift toward 15 confirming series represents firmer alignment around acceleration, even as some growth indicators like non-farm payrolls and housing start softened while others, such as the Atlanta Fed GDP tracker, improved. Historically, environments classified this way have often felt like cross-currents in markets. Commodities and inflation-sensitive assets showed strength in the record, while long-duration bonds faced headwinds as rates pressed higher. Again, a description of how past environments behaved, not instruction. On the yield side, the 10-year Treasury yield sits near 4.71%, while shorter maturities like the 2-year hover around 4.19%, keeping the curve modestly positive between those points and the 30-year near 5.28. The engine marks this as a green momentum configuration in long-dated yields, defined here as yields rising on a multi-week rate of change basis, while Treasury price indices still sit in the lower half of their recent range. Markets watch this because the 10-year and 30-year yields anchor discount rates for everything from equities to real estate and influence how investors price long-term inflation risk. The question it raises for a thoughtful investor is whether this rate backdrop changes how much duration or interest rate sensitivity they are comfortable carrying. In our framework's reading of comparable periods, this roughly coincided with long maturity bonds, lagging shorter maturity bonds within multi-week windows, an observation under our methodology, not a forecast. What would challenge this read would be a meaningful drop in long-term yields back toward prior lows, or a renewed steepening led by short rates instead of the long end. Labor data are softening at the margin. Initial jobless claims recently printed near 209,000 against expectations of about $210,000, and earlier July reports highlighted slower non-farm payroll gains and a slightly higher unemployment rate. The framework interprets this composite as yellow momentum, defined as a mild deterioration in employment growth. Job gains still positive but slowing, with the unemployment rate off its lows. Labor data matter because they sit at the core of how the economy generates income and how central banks judge slack or tightness in the system. The question a reader might ask is whether a softer labor backdrop makes current equity and credit pricing feel rich, conservative, or somewhere in between. In our framework's reading of comparable periods, this roughly coincided with more range-bound equity performance and intermittent volatility spikes within a few months, a record of past behavior, not a forecast. A renewed surge in hiring or a clear drop in claims would challenge that yellow reading. Credit spreads in riskier corporate debt, high-yield bonds, have narrowed modestly, which the engine records as green momentum in credit risk, defined as spreads compressing while default indicators remain contained. Markets watch high-yield spreads because they reflect how much extra compensation investors demand to own more fragile balance sheets. The key question here is whether tighter spreads feel consistent with a macro environment where both growth and inflation are accelerating, or whether that tightness feels stretched. In our framework's reading of comparable periods, this roughly coincided with credit markets absorbing macro shocks more smoothly over the following weeks, an observation under our methodology, not a forecast. What would challenge this interpretation would be a sharp widening in spreads or evidence that downgrades and defaults are increasing. On the equity sector side, healthcare, materials, real estate investment trusts, gold-linked equities, and long-duration bonds outperformed yesterday, while technology, financials, and industrials lagged. The engine classifies healthcare and gold-linked assets as green momentum, defined as prices rising with supportive rate of change and participation across those sectors, and technology as red momentum after a broad artificial intelligence-related sell-off. Sector rotation matters because it shows which parts of the market investors lean on when macro conditions shift. The question it raises is whether a tilt toward defensive or inflation-sensitive sectors aligns with an investor's own tolerance for volatility and drawdowns. In our framework's reading of comparable periods, this roughly coincided with uneven index-level performance as leadership rotated, a record of past behavior, not a forecast. A renewed broad-based technology rally or a reversal in commodity-linked sectors would challenge this pattern. Two if-then triggers are on the map today. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions, in our framework's reading, inflation composites historically showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. Within the regime context, a sustained move above that threshold in the past has often coincided with environments that the engine classified as moving from more benign expansion toward stronger acceleration or into stagflationary mixes in the data we studied. If the Equity Fear and Greed Index drops below 15 and holds there for 5 consecutive sessions, in our framework's reading, the regime confirmation score historically deteriorated in roughly 7 of 9 comparable conditions. Again, a historical characterization, not a forecast. In prior episodes, that kind of extreme sentiment reading often coincided with the framework reclassifying regimes or lowering confidence in the existing state. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework, price structure, rate of change, risk regime, and market participation across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. The Given engine is designed as a potential educational tool for understanding how 21 series and 407 symbols have historically behaved under different macro configurations, not as a guide for taking or avoiding any specific position. The Given engine operates independently of any brokerage or advisory function and remains focused on recording the math, not prescribing actions. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening, see which sectors are leading, and learn to read what's driving it yourself. That live view is the observation desk, the same 21 series and 407 symbols founding members study each morning, the environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1. You decide.